In this video, I'll be giving you guys 4 things that you should keep in mind in order to begin investing and starting this journey of your own, as well as giving you guys exactly how I would invest my first $1,000 into the stock market. First things first, in order to begin investing, you have to actually know what you are doing. A lot of people, when they start investing, they just kind of throw their money at certain stocks that they hear about, whether it's on social media or their friends. They don't exactly know why they're investing, and so they just throw money at something random, and then most of the time they end up getting burnt and they stop investing in general. You should only ever invest into companies that you are aware of, you know their company policies, and you have a high conviction that this company is going to be a stronger company in 1, 3, 5, 7, 10 years or so. When you invest into companies that you have a high conviction for, when you make profit on those companies, you have a sense of overwhelming joy because you did the research, you invested correctly, and you were right about it. On the other end, if you did a lot of research and you had a high conviction hold into a company that ended up going down, it's not as worrisome because you are still looking at the long-term financial success of that company that you're invested in. When you are buying stocks, you're not just randomly throwing your money at stuff. You're not at a casino. You are physically buying portions of a company. You are now a part owner of Apple if you buy a share of Apple stock. That's all that it means. And so when you own a share of Apple, you're saying, I own this small portion of Apple. And if Apple does well, that means my portion of Apple is now worth more money. So only invest into companies that you believe that are going to make money, that you would be proud saying that I am a part owner of this company. You do not invest to make money fast. You invest to make money safely, securely, and over the course of a long period of time. You see, the company, the person who made that company, took a long time to make it successful. If that was 5, 10, 15 years, why would you expect to make any more money than they did in just a couple of weeks? People tend to not have a lot of patience with investing, especially new investors. You have to understand that the more time you spend practicing and buying stocks and moving with things, whether it's with paper trading or with real money, you have to understand that the more practice you have with this and the longer you do it, the better you will become at it. And the more secure your future returns will be, instead of just buying and selling and attempting to day trade or swing trade. Whatever that looks like, it is way easier and safer just to buy a stock you believe in and hold on to it for 10 years. So to summarize, first step is understand what you are investing into, what you're actually doing. You are buying a portion of a company and you are now calling yourself a part owner. So only become a part owner of a company or a business that you believe will be successful in the future. This will then return you money on your investment. So only invest into companies that you believe in. Another tip for new investors is diversification. Imagine sitting in a chair with only 2 legs. It would be unstable. Now imagine sitting in a chair with 8 legs. It is far more secure and far more stable. Just like with stocks, you don't want to invest all of your money into one stock or 2 stocks, but instead over a diversity of those stocks. Because if one stock does bad over the course of a month, you don't want that to tank your entire portfolio. If you are diversified, that won't affect your portfolio nearly as much as if you owned solely that one stock or one of 2 stocks. Diversification is crucial for risk management. Investing is literally just understanding how much risk you are willing to take on at one time. As an investor, if you don't have a high risk tolerance, why would you then go investing into really high volatile stocks or cryptos or putting all of your money into one place? It wouldn't make sense. The goal is to make a lot of money securely for our future to be set up in financial freedom. With diversification, we are not gambling. We're not putting all of our money into one thing hoping it blows up. But instead, we're looking strategically at the market, looking for what things are undervalued, what things might be overvalued, when we should buy, when should we sell, things of that sort. It's a very fluid motion. You can't be all in on one thing. You have to look at the broad, bigger picture of things in order to have the highest chance of a financial positive return in your future. The third thing for new investors is that they need to understand compounding gains. If you were 18 years old and you invest $1,000 today, and for the next 12 years you invest $100 a month at an 8% return, which is the average for the S&P over the last 100 years, you will have over $25,000 saved up with only $15,400 in cash that you actually invested. Now, that doesn't seem like a lot of money, but if you did that for 30 years instead of 12 years, you would have over $147,000 with just 37 invested. Obviously, the more money that you start with and the more money that you can invest monthly and the longer that you do it for and the bigger or smaller the returns you get will all change this outcome. But ultimately, the goal is that what you can do it now. Do it as young as possible and for as long as possible. Warren Buffett is currently 94 years old. He has a net worth of $81 billion. But what if I told you that 80 billion of those dollars came after the age of 50? You see, Warren Buffett actually started investing at the age of 10, and over the course of 84 years, he accrued 81 billion of a net worth, with 99% of that being after the age of 50. All due to compounding interest. You need to get rid of the get rich quick mentality. Once you understand that what your money now can do in 20, 30, 40 years, you'll quickly understand that the pros far outweigh the cons. That little bit of money that you have left over, that Christmas bonus that you got, put it in and your future self will thank you. And don't be upset when you're 40, 50, 60 years old and you don't have a savings because you didn't want to be disciplined at a young age. Start now. Age matters. The amount of time that you spend in the market matters. My fourth tip that I would have if you were a beginner looking to invest $1,000 would be that consistency is more important than the amount that you are investing. Imagine you have two investors. Investor A invested $100 a month for the next 20 years for a total of $24,000 invested. Well, he would be sitting pretty good at right around $55,000 total. Now, say investor B, on the other hand, who had $24,000 and invested it just this year at an 8% rate, next year he will have $26,000. So despite it being the same amount of money invested, the investor A, who spent more time in the market and took advantage of compounding interest, was set up far well ahead than investor B. Just like how I said earlier, you need to have a high conviction in what stocks you buy. Because if you want to be consistent, that means you need to buy good or bad. When the stock's going up and it's green, or when the stock's going down and it's red. Whenever you see that stock and it is red, do not panic. It is an opportunity for you to buy exactly what you want at a discount. If you saw your favorite pair of shoes at the mall and they were discounted and they were cheaper than what they normally go for, you would be so excited to buy it. So in this opportunity that you have in this stock that you have a high conviction for, when you see it go down and it's red, take it as a buying opportunity. Good or bad, stay consistent in your purchasing and stay consistent in your investing. I'm currently reading a book called The Psychology of Money, and the author writes about two investors. An investor who since the year 1920 invested $1 a month, and an investor who only invested $1 if the month was good and there wasn't a recession. The difference between the first and the second was about a $200,000 difference. Investor 1, who invested regardless of recession or not, had $400,000. Investor number 2, who only invested on the good months, only had about $200,000. So good or bad, keep the long term in mind. It doesn't matter if it is a good stock to buy, as long as it'll be good in 10, 15, 20 years. So like I mentioned earlier, whenever you see red, you buy. Whenever you have these high conviction beliefs on companies and it's a discounted price, you buy. This is like guilt-free shopping. You get to spend money on things that are going to bring you a profit in the long run if you play your cards correctly. Now, with all that being said, with understanding what you're investing into, diversification, compounding interest, and being consistent with your investments, let me show you guys exactly how I would invest $1,000 if I started today. I would invest $400 into ETFs. More specifically, I would invest that money into SPY, which follows the S&P 500 index. I did a video explaining what the S&P 500 is and other ETFs, but you can go ahead and watch that video right here. That $400 going into the S&P is ticking off that diversification box. With over 500 of the top US companies, I'm pretty well set here. Next, I would invest $300 into tech stocks. With the future of AI and quantum computing, I definitely see this as something that has a large future growth potential. Stuff like Apple, Microsoft, Nvidia, Tesla, these things are beautiful tech stocks that have a large growth potential. So $300 into tech stocks. Next, I would take $100 and I will put that into a financial service sector stock. something like JP Morgan or Morgan Stanley, something of that sort, a bank or a financial institution that you believe is a safe and secure stock for you to put your money into. Now with your last $200, I would say just keep it in cash. Keep that money into your exchange and just keep it there for good opportunities to buy. Whenever you see a market turn red or whenever you see a stock that you want to buy turn red, take some of that $200 and buy some more of it. Now, I wouldn't make these purchases all at once right now. If I had $400 to spend in the S&P, I would probably put $200 right now, and I would spread the remaining $200 over the course of the next 10 or so business days. With this strategy, you are dollar cost averaging, meaning that your average price per share that you paid isn't going to be stuck at what you did the first time you invested, but it's going to move with the market, whether down or up, and hopefully over the course of time, you moved well enough where that dollar cost averaged out really well, and the stock is outperforming that average. Now, to get the consistency side of things checked off, I would say this. If you make $35,000 a year, a pretty base salary, and that you allocate 10% of that budget to investing, that's about $300 a month. What I would do is I would set up a recurring investment. Every single day, I would have invested $5 into an ETF, $3 into a tech stock, and $2 into a financial service industry stock. That is a total of $10 a day. If you have those recurring $10 a day going throughout the month, throughout the year, that stuff will add up and it is automatically set up. So you don't have to make that conscious decision. It's just happening. And if you make $35,000 a year, you can probably afford a $10 transaction a day. For most of you, your coffee is about $8 and your meal is about $15. Make room for it somehow. If you take this advice and you invest $1,000 initially, and you set up a recurring investment of $10 a day, in 20 years, you will have $170,000 projected with only $73,000 in cash invested. The goal here in investing is to have high convictions, diversify, understand the compounding significance of investing, and be consistent. This will set you up in a way when you are older that you can have that dream house, that dream vacation, that dream car, all the things that come with financial freedom at the cost of discipline at a young age. With all that being said, if you found this video informative and useful, please leave a like down below and consider subscribing. I make a ton of videos regarding finance and investing, so if that's something you were interested in, please subscribe down below. If you have any questions, comments, concerns, please leave them down below in the comment section or DM me on Instagram at Rubenuzun, and I'll make sure to reply on there. Also, if you just started your investment journey and this helped you, please leave a comment down below. I would love to celebrate with you and understand exactly the impact that these videos are making. But with all that being said, keep investing, keep learning. I'll see you next time.